What will we study at this level? What is Forex? How do you trade Forex? When can you trade Forex? Who trades Forex? Why trade Forex? Understand how your margin account works. What is Forex? If you've ever traveled to another country, you usually had to find a currency exchange booth at the airport, and then exchange the money you have in your wallet into the currency of the country you are visiting. You go up to the counter and notice a screen displaying different exchange rates for different currencies. An exchange rate is the relative price of two currencies from two different countries. You find Japanese yen and think to yourself, wow, my $1 is worth 100 yen. And I have $10. I'm going to be rich. When you do this, you've essentially participated in the Forex market. Before you fly back home, you stop by the currency exchange booth to exchange the yen that you miraculously have remaining. Tokyo is expensive, and notice the exchange rates have changed. It's these changes in the exchange rates that allow you to make money in the foreign exchange market. The foreign exchange market, which is usually known as Forex or FX, is the largest financial market in the world. The largest stock market in the world, the New York Stock Exchange, NYSE, trades a volume of about $22.4 billion each day. Compared to the measly $22.4 billion per day volume of the New York Stock Exchange, NYSE, the foreign exchange market looks absolutely gingermouse with its $6.6 trillion a day trade volume. You hear about the NYSE in the news every day, on CNBC, on Bloomberg, on BBC, you even probably hear about it at your local gym. When people talk about the market, they usually mean the stock market. So the NYSE sounds big, it's loud and likes to make a lot of noise. But if you actually compare it to the Forex market, it would look like this. Check out the graph of the average daily trading volume for the Forex market, New York Stock Exchange, Tokyo Stock Exchange, and London Stock Exchange. The currency market is over 200 times bigger. It is huge. But hold your horses, there's a catch. That huge $6.6 trillion number covers the entire global foreign exchange market, but the spot market, which is the part of the currency market that's relevant to most Forex traders, is smaller at $2 trillion per day. And then, if you just want to count the daily trading volume from retail traders, that's us, it's even smaller. It is very difficult to determine the exact size of the retail segment of the FX market, but it's estimated to be around 3 to 5% of overall daily FX trading volumes, or around $200 to $300 billion, probably less. So you see, the Forex market is definitely huge, but not as huge as the others would like you to believe. Aside from its size, the market also rarely closes. It's open virtually round the clock. The Forex market is open 24 hours a day and 5 days a week, only closing down during the weekend. So unlike the stock or bond markets, the Forex market does not close at the end of each business day. Instead, trading just shifts to different financial centers around the world. The day starts when traders wake up in Auckland/Wellington, then moves to Sydney, Singapore, Hong Kong, Tokyo, Frankfurt, London, and finally, New York, before trading starts all over again in New Zealand. What is traded in Forex? The simple answer is money. Specifically, currencies. Because you're not buying anything physical, Forex trading can be confusing, so we'll use a simple, but imperfect, analogy to help explain. Think of buying a currency as buying a share in a particular country, kinda like buying shares in a company. The price of the currency is usually a direct reflection of the market's opinion on the current and future health of its respective economy. In Forex trading, when you buy, say, the Japanese yen, you are basically buying a share in the Japanese economy. You are betting that the Japanese economy is doing well, and will even get better as time goes. Once you sell those shares back to the market, hopefully, you will end up with a profit. In general, the exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy, compared to other economies. By the time you graduate from this level pipsology, you'll be eager to start working with currencies. Major currencies. While there are potentially lots of currencies you can trade, as a new Forex trader, you will probably start trading with the major currencies. They're called major currencies because they're the most heavily traded currencies and represent some of the world's largest economies. Forex traders differ on what they consider as major currencies. The uptight ones who probably got straight A's and followed all the rules as children only consider USD, EUR, JPY, GBP, and CHF as major currencies. Then they label AUD, NZD, and CAD as commodity currencies. For us rebels, and to keep things simple, we just consider all 8 currencies as the majors. Below, we list them by their symbol, country where they're used, currency name, and cool nicknames. Code, country, currency, nickname. USD, United States, dollar, buck, EUR, Eurozone, euro, fiber, JPY, Japan, yen, yen, GBP, Great Britain, pound, cable, CHF, Switzerland, franc, Swissy, CAD, Canada, dollar, loonie, AUD, Australia, dollar, Aussie, NZD, New Zealand, dollar, Kiwi. Currency symbols always have three letters, where the first two letters identify the name of the country and the third letter identifies the name of that country's currency, usually the first letter of the currency's name. These three letters are known as ISO 4217 currency codes. By 1973, the International Organization for Standardization, ISO, established the three-letter codes for currencies that we use today. Forex trading is the simultaneous buying of one currency and selling another. Currencies are traded through a forex broker or CFD provider and are traded in pairs. Currencies are quoted in relation to another currency. We will discuss the forex brokers and the best of them in detail in the upcoming lessons. Do not worry. For example, the euro and the US dollar, EUR/USD, or the British pound and the Japanese yen, GBP/JPY. When you trade in the forex market, you buy or sell in currency pairs. Imagine each currency pair constantly in a tug-of-war with each currency on its own side of the rope. An exchange rate is the relative price of two currencies from two different countries. Exchange rates fluctuate based on which currency is stronger at the moment. There are three categories of currency pairs: the majors, the crosses, the exotics. Major currency pairs. The major currency pairs always include the US dollar. The currency pairs listed below are considered the majors. These pairs all contain the US dollar, USD, on one side and are the most frequently traded. Compared to the crosses and exotics, price moves more frequently with the majors, which provides more trading opportunities. The majors are the most liquid in the world. Liquidity is used to describe the level of activity in the financial market. In Forex, it's based on the number of active traders buying and selling a specific currency pair and the volume being traded. The more frequently traded something is, the higher its liquidity. For example, more people trade the EUR/USD currency pair and at higher volumes than the AUD/USD currency pair. This means that EUR/USD is more liquid than AUD/USD. Major cross-currency pairs or minor currency pairs. Currency pairs that include any two of the major currency or except the US dollar are known as cross-currency pairs or simply as the crosses. Major crosses are also known as minors. While not as frequently traded as the majors, the crosses are still pretty liquid and still provide plenty of trading opportunities. The most actively traded crosses are derived from the three major non-USD currencies, EUR, JPY, and GBP. Exotic currency pairs. An exotic currency is a currency from countries with developing or emerging markets. Exotic currency pairs are made up of one major currency paired with the currency of an emerging economy, such as Brazil, Mexico, Chile, Turkey, or Hungary. Basically, an exotic currency pair includes one major currency alongside an exotic currency. The chart below contains a few examples of exotic currency pairs. Want to take a shot at guessing what those other currency symbols stand for? Keep in mind that these pairs aren't as heavily traded as the majors or crosses, so the transaction costs associated with trading these pairs are usually bigger. Depending on your forex broker, you may see the following exotic currency pairs, so it's good to know what they are. It's not unusual to see spreads that are 2 or 3 times bigger than that of EUR/USD or USD/JPY. Due to the overall lower degree of liquidity, exotic currency pairs tend to be far more sensitive to economic and geopolitical events. For example, a political scandal or unexpected election results can cause an exotic pair's exchange rate to swing violently. So if you want to trade exotics currency pairs, remember to factor this in your decision. For those of y'all who are really mesmerized by exotics, here's a more comprehensive list. G10 currencies. Aside from the three main categories of currency pairs, there are other groups of currencies that are thrown around in the FX world which you should be aware of. The G10 currencies are 10 of the most heavily traded currencies in the world, which are also 10 of the world's most liquid currencies. Traders regularly buy and sell them in an open market with minimal impact on their own international exchange rates. What is a currency pair in Forex? A currency pair is a pairing of currencies where the value of one is relative to the other. For example, GBP/USD is the value of the British pound relative to the US dollar. What are the major currency pairs? Major currency pairs, majors, are those that include the US dollar and the most frequently traded. There are 7 of them: Euro USD, USD JPY, GBP USD, USD CAD, USD CHF, AUD USD, and NZD USD. What are the currency crosses? Currency crosses, are the more frequently traded currencies that do not include the US dollar in their pairing. Crosses include your GBP, your CAD, GBP JPY, your CHF, your JPY, etc. How many currency pairs exist? There are hundreds of currency pairs in existence, but not all can be traded in the FX market. The United Nations currently recognizes 180 currencies. If you were to pair each currency up with another, it's a lot. Forex market size and liquidity. The bulk of Forex trading takes place on what's called the interbank market. Unlike other financial markets like the New York Stock Exchange, NYSE, or London Stock Exchange, LSE, the Forex market has neither a physical location nor a central exchange. The Forex market is considered an over-the-counter, OTC, market due to the fact that the entire market is run electronically, within a network of banks, continuously over a 24-hour period. This means that the FX market is spread all over the globe with no central location. Trades can take place anywhere as long as you have an internet connection. The Forex OTC market is by far the biggest and most popular financial market in the world, and it is traded globally by a large number of individuals and organizations. In an OTC market, participants can be picky and determine who they want to trade with depending on trading conditions, the attractiveness of prices, and the reputation of the trading counterparty, the other party who takes the opposite side of your trade. The chart below shows the 7 most actively traded currencies. The US dollar is the most traded currency, making up 84.9% of all transactions. The euro's share is second at 39.1%, while that of the yen is third at 19.0%. As you can see, most of the major currencies are hogging the top spots on this list. The dollar is king in the Forex market. You've probably noticed how often we keep mentioning the US dollar, USD. If the USD is 1/2 of every major currency pair, and the majors comprise 75% of all trades, then it's a must to pay attention to the US dollar. The USD is king. In fact, according to the International Monetary Fund, IMF, the US dollar comprises roughly 62% of the world's official foreign exchange reserves. Foreign exchange reserves are assets held on reserve by a central bank in foreign currencies. Because almost every investor, business, and central bank own it, they pay attention to the US dollar. There are also other significant reasons why the US dollar plays a central role in the Forex market. The United States economy is the largest economy in the world. The US dollar is the reserve currency of the world. The United States has the largest and most liquid financial markets in the world. The United States has a stable political system. The United States is the world's sole military superpower. The US dollar represents about half of international loans and bonds. Lots of countries and foreign companies borrow in USD. The US dollar is the medium of exchange for many cross-border. For example, oil is priced in US dollars, also called petrodollars. So if Japan wants to buy oil from Saudi Arabia, it can only be bought with the US dollar. If Japan doesn't have any dollars, it has to sell its yen first and buy US dollars. Basically, the world is heavily dependent on continuous USD supply to facilitate trades, payments, and loans. Speculation in the Forex market. One important thing to note about the Forex market is that while commercial and financial transactions are part of the trading volume, most currency trading is based on speculation. In other words, most of the trading volume comes from traders that buy and sell based on the short-term price movements of currency pairs. The trading volume brought about by speculators is estimated to be more than 90%. The scale of the Forex market means that liquidity, the amount of buying and selling volume happening at any given time, is extremely high. This makes it very easy for anyone to buy and sell currencies.